Good morning, everyone, and welcome. Joe Scarice, your co-founder and co-host of the Creative Birth Strategy House and podcast here every Saturday morning, 8 a.m. Eastern Standard Time, and every Sunday morning, 9:30 a.m. Eastern Standard Time. So we'll get ourselves started and get rolling and start inviting some people in. Give me just a few minutes to get myself set up, and we'll get rolling here in just a few minutes. And let's see here. All right. What a busy week it has been. I've been on the road a little bit. We'll go over that a little bit in just a few minutes. Rolling into another great week of real estate investing and networking and strategy. But I have to say, it was a really great week meeting people, a lot of new people, which is nice. And then rekindling old relationships and current relationships, which is always another great thing to be involved with. So the best part about real estate is you could really just have a whole new day every day. You're out there networking with people and creating relationships and building and strategy and you know just just being out there and being a network for the most part. So we'll get started here in just a few minutes, and we're going to invite some people in. If you want to share this out, let's see here. All right. So the week been a very bit interesting week with the bond market. Very interesting week with the rates. Um, the Fed made this massive announcement. It was going to be this game-changing opportunity for consumers to come off the sideline. They dropped their rates a half a point, and all of a sudden, we were going to see a whole big different fall market. And the bond market said, "Screw you." We're still in an inflationary and recessionary environment. We drove the bond market up. The Treasury notes went up. All that complete erosion to any benefit of the half a point drop. So now the Fed's looking at themselves with CPI reports and jobless claims and saying to ourselves, we didn't do enough. And do we need to really drop the rates? Because inflation is not going to is not going to come down drastically if we keep dropping the rates, if nobody's doing anything, nobody's coming off the sidelines. We have these looming wars in the Middle East. We still have political unrest. We don't know where we're going to end up in November. And depending on who ends up in November as president, will definitely weigh heavy on rates, heavy on the economy, with a lot of looming different things coming around. Commercial office retail resetting, inflationary issues, recessionary issues, erosion of the middle class, institutional buyers buying up land and building out build-to-rents and building out apartment complexes throughout all these malls. What's that going to do to the small landlord like ourselves? We have to think all this through because it could impact our bottom line as real estate professionals, long term. But on the short term, I think it's a very unique opportunity for investors because when people are scared, they don't buy houses in the sense of a consumer play. It's definitely going to be an investor play. I have several clients that are increasing their buying and going after more properties that are sitting on the market that need some light rehab and turning it into more of a rental environment because they feel the next 2 to 3 years nobody's buying houses to live in. They're going to rent houses. Now, could that be a flooding of rentals or good rentals? Yeah. And is it going to fill in a lot of the backlog of Section 8 affordable housing opportunities for some people? Yes, I agree on both of that. But I do believe, where rates are that we're supposed to be, we closed out at the mid to high sixes. But irony enough, in the commercial space, we're putting loans together between 6.5% and 7% right now. So we're dead even with the bank environment. The non-bank environment is literally eating about 70% of the inquiry of investors right now. The other 30% might just not be aware of asset-based lending. So it's kind of an interesting anomaly as this industry grows. Hard money still exists. That's more relationship oriented where people they want to go back to the same person for the hard money. But a lot of those people are realizing that asset-based lending offers the short-term and long-term space. So it's tying into a bigger piece of the pie for investors to look at as this market kind of shifts around. So let's first recognize our sponsors, of course. I'd love to thank Mr. Yurdell Perkins of Perkatech. He's back up and running 100%. He's our social media strategist, as I call him, the Oz behind the drape. This podcast would not be here without him and his partnership in this, and his consistency and his commitment to the podcast. I'd like to thank Miss Linda Pelagas of Realty 411. It's a national publication. She provides national events throughout the country for real estate professionals. And she has a big event coming up this fall in Los Angeles at the Grand LA RIA Expo. I can't make it this year because of other obligations, but it's always a great event to be in attendance of. I'd like to thank MB Capital, where I am a referral partner for unsecured business lines of credit. It provides unsecured business lines of credit for clients in the real estate space and also the business-to-business space. If you'd like to have any questions on that or become a referral partner, please let me know. And I'd like to thank Lenmark, where I'm a senior loan analyst, providing asset-based lending in the debt service coverage space, long-term rental, short-term rental, midterm rental, fixed to rent, fixed to flip, new construction, multifamily space, and mixed use nationwide in all 50 states. And we provide advisory and strategy for real estate professionals in regards to building out their real estate portfolio. So let's get caught up in our articles this morning. I gave my little rant of the economical unrest. Inflation is very present still. A recessionary environment is very present still. Loan applications are down on the consumer space. Loan applications are up on the investor space. House prices are flattening. The hurricanes Helene and Milton definitely put a hamper onto the USD GDP. The strike on the ports definitely threw a little monkey into the wrench. You need to be staying abreast of what's going on in this market. It's very important because there's so many different moving parts that impact your bottom line as a real estate professional or a real estate investor. Remodeling market sentiment dips in the third quarter. Cost of living adjustment increased by 2.5%. And your contribution toward living expense went up. So everything is moving up. You need to figure out how to create revenue stream, how to become more of a better real estate professional, improvement, getting a better circle of people around you, creating opportunities. Okay. So I got somebody putting some blogs up here. So why don't we just delete that? Delete that. Okay. Sorry about that. I'm getting a message on my chat room here that I'm not really sure what that's all about. But you need to pay attention to data, to how that will impact your bottom line as a real estate investor. So pay attention to the 5-year treasury if you're a real estate investor. If you're really worried about consumers buying homes to live in, follow the 10-year treasury. Get entrenched with that information, okay? That's some of the news there. Some interesting articles that caught my eye this week. We'll talk about that real quick. Housing market flirts with recession, okay? Homeownership expenses spike across the United States. So these are two very interesting articles I'll be posting up over the next several hours on my feeds. So asking rents have jumped right now a little bit because mortgage rates have settled out a little bit. So competition, depending on where you're at, either there's a higher vacancy or rents are surging. So you got to kind of watch that balance. It'll be interesting to see what happens in Florida, in the flood zone areas in North Carolina, what goes on with rents and properties, because most of the people that got flooded in either Florida or North Carolina did not have flood insurance. So how are they going to recover those properties is going to be very interesting. And the government was so kind to give $750 per household, not per person, for FEMA relief. So that's going to be another interesting circumstance to watch and see how people recover in both of those areas. So interesting articles on Mortgage News Daily and market trends on mortgagepoint.com, which I post a lot of those articles. And I also, the discussion we're going to have today, what is the most important factor to your real estate buy box? It has been posted on LinkedIn and several of the other social media sites, my article that I write to complement our podcast. So what is a real estate buy box? A buy box in real estate refers to the specific criteria or guidelines an investor sets for properties they are interested in pursuing or purchasing. These criteria help to narrow down the search to properties that meet their investment goals and risk tolerance. So real quick, we'll go over like the typical buy box scenarios. Okay. Location, city, neighborhood, demographics, proximity of amenities near schools, public transportation, shopping areas, neighborhood designations. These are a lot of people base their buy box on that type of criteria. Number two is the property type. Is it single family homes through four family? Is it multifamily, meaning 5+ units? Is it condos or townhomes? Now you got to be concerned about HOA and other people involved. Is it commercial properties like a mixed use with a residential commercial blend or warehousing or just office retail? And then there's vacant land. You could play the development player if you want. Property size. What is the typical square footage of what you're looking to identify? What are the number of the bedrooms and bathrooms that you'd like? Okay, per unit. Some people don't buy anything less than a 3-bedroom, 2-bath. Some people, when they buy a 2-family, they want no 1-bedrooms. They want 2 or 3 bedrooms. When it's a condo, it needs to be 2 or 3 bedrooms at least. No 1-bedrooms. What's the price range? What is your financial capability? People always ask me, what's my financial capability to buy a property? So are we buying a burr? Or are we buying a DSCR? I need to know what you're trying to accomplish, because if you're buying a DCR, your minimum down is 20%. On a burr, you need to show 20% availability typically for reserves and acquisition. So it all depends. And then what type of condition property are you looking for? Are you looking more turnkey, ready to rent or sell, fixer upper, needs some renovations, but has potential for a higher return, or a development opportunity, land or property with potential for new construction? And then you have to think about cash flow and return on investment, your ROI. What is your targeted cash flow after expenses and desired DSCR and cash on cash return? What is the minimum ROI you want to make every month? And what's your strategy, whether to hold or flip or midterm rental or short-term rental? I went to an event last night in regards to short-term rental, and believe it or not, short-term rental in the Poconos is still staying very hot. And a lot of people are taking it very seriously. I know I've met people last night that have 15 to 20 to 30 different short-term rentals right now, active. Irony enough, I was going to stay up there last night in the Poconos. I came up Thursday after doing a great presentation. I had a lot of fun presentation in Lehigh Valley. So I stayed up in Stroudsburg. I stayed for $95 a night, Thursday night. If I wanted to stay Friday, it went up to $300. So I was like, I'm just going to drive home. That's ridiculous, right? So it's still staying very frothy up in that area. And then you got to take in some risk factors. What are the economic factors of your market? Market trends, job growth, rent increases or decreases, and the neighborhood factors. Like, what's the crime look like? What's the school ratings look like? What's the gentrification potential in those neighborhoods? So these are some things you need to think about when it comes to your real estate buy box to get started here. So we'll start off with our moderators and get some nice introductions and a little overview and see where they're up to this week. Justin, good morning and welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning. What is the most important factor to your real estate buy box?
Good morning, Joe. Good morning, everybody. Here.
Yep.
I'm in the Southern Louisiana market. I'm an investor. I should say, but I've done several fix and flips. Built some properties for other people. One or two. Managed builds to be specific. I do construction management. I'm a criminal license. Since 2011. Anyways, when it comes to this topic right here, Joe, I think it's the key time to check in and kind of reanalyze things. Because like I said, things have been changing. Set your game plan because I think things have been a little bit more quiet on the change side. I think over the past 2 years, there's been a lot of noise about the adjustments being made in the market and how we might want to keep our eyes open for change. Um, Now I think that change, well, maybe just for me, can kind of sneak up on you. And the reason I say that is my buy box is probably going to be something along the lines of multifamily, and it's going to be a newer product. Now that's just a buy box. Obviously, for me, that's a build box. Okay, so that's something that I believe would be the best product on the market for an investor and maybe even a first time home buyer. I think that product creates good stability for the long term and the short term. Um, and so, if you're giving yourself a 5 to 10 year window to uh, refinance, sell, dispose, or do whatever with a project, get a full cycle out of an investment property. Give yourself 5 to 10 years to do that. You need to think about all of the things that could possibly happen in those 5 to 10 years. One thing that I've paid attention to is the last 5 to 10 years, the world has increased tremendously at the pace that it grows and the pace that it changes what the standard is. So it nowadays, like I feel like when I was younger, it took a while to make an adjustment for things in the world. I can't really say what was going on 20 years ago in real estate, but I can just thinking about regular, everyday regulations and so on and so forth. I think nowadays we're quicker to react. We're able to react quicker, and the response can get to the market. It can get to the people, the masses quicker. So we adjustments need to be made quicker. So I just think having something that allows you a little bit of flexibility on the resale side, right, by being a better product, it allows you longevity by having lower maintenance. I think those are the things that you need to really consider when you're getting into things right now. Really know your skill sets, and you're going to be doing some flip, not totally out of out of the question to be flipping houses right now. But you absolutely need to have your stuff down to science. And maybe if you're doing a different strategy, other than single family homes or small multifamily, then you really want to make sure. Like right now, I would be putting up more equity on my buys and my mid size or larger multifamily acquisitions. Right, if I get the opportunity to buy 15, 20 plus. I mean, I'm sorry, not 15, 12 to 20 units or 12 to 30 units or something like that, maybe myself. But I always keep my eyes open for that and some partners. If we get that opportunity, we're going to look for a high equity position in that. So I guess all that I'm saying is making sure you're positioned in a safe place where you can pivot quickly if in case something happens in the market. I think that's one of the things that we got to pull to the top of our underwriting is just for unforeseen things to take place with the investment. So that's just my thoughts.
Justin, thank you for your insight. Always appreciate Justin's presence. He's been dedicated as part of this group and club for several years now. So I always love to see him here. Um, he brought up something, the real estate skill sets that tie into your real estate buy box. To succeed in the real estate industry, whether you're an agent, investor, property manager, there are several key skill sets you need to develop. These skills will apply across various areas of real estate, including residential, commercial, midterm, short-term rentals. I'm going to break it down real quick. Market analysis, understanding your local markets, market research, financial forecasting. What's the appreciation of your property values and what are the potential returns? If you can't flip it, can you rent it? You need to underwrite both. And you have to have financial acumen. You need to understand budgeting and cost estimation. You need to understand cash flow analysis. You need to have financial strategies, not just for yourself, but for your potential clients. Now, tomorrow's discussion, we're going to be talking about white label marketing, so you could actually broker your own loans. And that's going to be a whole nother deep dive into lending for the investor. And you need to have good negotiation skills, buyer and seller. You have to have good contract negotiation skills as well, understanding real estate contracts. Just don't sign things, review it, read it. But then you have to have marketing and sales skills, property promotion, lead generation. Right now, we're going through a whole SER reset for our lead generation on our side for myself and Yordell. I'm spending thousands of dollars to round the wagons on our brand for the podcast and ourselves. Salesmanship, you have to build rapport and showcase properties effectively and close deals, right? You have to have some form of legal knowledge. Nobody here is an attorney. We don't play one on Clubhouse. I'm not giving you any type of advice. Don't sue me. But you need to be present and understand real estate law, familiarity with contracts, deeds, title, leases, zoning regulations, and landlord tenant laws, knowledge of eviction processes and rental agreements and tenant rights, communication and networking, client relations, networking. Last night I was in an event with 50 people. I met probably 48 of them, gave my card out to each one of them, following up with every one of them, hopefully this morning. And being able to handle conflict resolution, handling disputes, tenant issues, or property management problems. Right now, one of our clients is having a problem with their property management company. We're stepping in and trying to facilitate whatever he might need. He has 400 doors. That's somebody we need to stick by and be part of, because that spirals out to other opportunities for ourselves as well. And I think that a lot of people don't realize your buy box ties into whoever is managing your property, whether you're self-managing or property management, the maintenance and operations, the tenant relations. Getting in and out of a unit is extremely complicated right now because, post-COVID, everybody's scared of everything. And then the technological savviness, like, are you set up with keypad entry? Do you have video work around your properties? Okay, protective measures. Then there's project management and time management and cost control. There's risk management, understanding risk and mitigating strategies, and adaptability and problem solving, dealing with market changes and being creative with solutions. Stephen, good morning and welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning. What is the most important factor to your real estate buy box?
Hey, good morning, Joe. Thanks. Yeah, I'm Steve Branco. I'm a broker, landlord. My main brand is REI Homepage, where I help people learn about real estate, give them the tools to be, whether they're a wholesaler or whatever. And I also really focus hard for my own buying. And I've always made a joke that while everyone else has been buying over the last 4 years, I've been happy selling stuff to them because nothing fit my buy box. If I'm buying cash flow, I'm very hard on the number. Now, I live in a unique market in northeastern Pennsylvania. I can take out what used to be 30% is now 20% as a soft pad for maintenance vacancy management, and I can still make the rest of my numbers work. And for me, I do it on, I definitely need to clear DSCR, but I also look at, I won't even glance at it if after hard cost rent minus hard cost minus a pad for maintenance vacancy management, if it's not a quick number that clears 10 cap, I'm going to move on from it. You're in a more filling market, more aggressive market, you might play that number differently, but I look at it in terms of I'm eating off my rentals, I'm living off my rentals. So I need to make sure that every rental comes on board, able to support its own soft costs like maintenance, management, and so forth, and able to put enough money in my pocket after mortgage and everybody, cash on cash return, to make it worth it. For me, I'm here. I'm getting into a little bit of more build for rent, but it's really affordable. This is a small market. This is very much a logistics and healthcare worker and not a very highly paid market. So those are primarily who my tenants are. So I'm looking at affordable. I also like mobile home parks. I'm actually buying a couple mobile homes to rent. The same thing, affordable. And I'm looking at a few self-storage opportunities. Again, I'm aiming at those people that have more stuff than they do space at home. So up here, that's what I'm seeing. Personally, what I'm avoiding is, which I wasn't a few years ago, is kind of avoiding most shopping centers. I'm pretty much avoiding most offices since COVID. If it can be outsourced, it's going to be. So I'm staying over on that side of those parts of commercial I'm more concerned with. I also in the commercial space have clients that I'm not directly involved with. They love what I call the SIN systems, the convenience stores, the vape shops. Of course, laundry and car washes aren't great examples of SINs, but those kinds of conveniences aimed at in our area, the buyers of a lot of those things are of the affordable demographic. So that's kind of my song on it. Is it's got to have high cash flow, and it's got to work. If I'm going to do a flip, my friend Mike does a lot of high-end, $1 million flips. I love it. It's great. Not sure I'm going to dive in there. I think the flips that I do are still going to remain affordable because I don't know what's happening after November. So that's kind of my point of view. I'm selling to the widest part of America, which is the affordable market.
So, Steve, you touched on some great points here. So, the higher end market, there's a lot of higher risk. I know we both have the same mutual colleague. Where could things go really sideways for him, economy wise? I mean, there's only so many people that buy 500,000 and above properties, right? And in a specific market, you know, do you see that is he resetting some things in what he's looking at now and how he's building, or is he kind of sticking to the same model? I mean, what's changing up at that market in the last 6 months because of the economy, recession, and political unrest? What are you seeing different right now?
So I think on the higher end stuff, because I'm actually looking at a couple up in the hideout where Mike builds and I might do them, because that economy for us around here, above a half million, certainly into the millions, lower millions, like 850, 1.2. Those are high end homes. This is not, in Boston, that's like your average house. But out here, those are high end homes. And a lot of those, he hasn't seen those slow down too much. We're talking about this on Wednesday. He hasn't seen those slow down too much, kind of because a lot of people in that sector, the money becomes less of an issue. You've got that consistent income. You've got those assets. This isn't a little quick pumps for you. And also because the markets out there, this is mostly Pocono and so forth, are very much, as you say, still in demand. What I'm seeing is that on my higher end buyers, they're just a little more wanting more value for the buck, which is again where the build to sell works well, because you can sell, it's all brand new, it's all this, it's maybe custom, it's whatever, So I'm seeing the uncertainty that I'm seeing is a lot of it on the investor side. They're being what they should have been. They were asleep for several years and not looking at the fundamentals, but now they're looking at the fundamentals as a question. And on the affordable buyer scenario, my agents that run buyers around here, they're a little more nervous because they think, well, if the economy continues to retract, if my job gets in trouble, I better not spend 200,000. I better spend 175, or as we all know, doesn't want to change the mortgage that much, but they're being a little more cautious. They're being a little bit more cautious, but the buying is still strong. I do have a few properties that I thought would fly off the market because they're simply not getting interest. But Mike seems to be doing quite well in that sector. But of course, he's also on the builder side. He owns a distributor for maybe I think a couple for modular homes. So he gets them whether he's building them to sell or whether someone's coming to him for a house. So that strategy played out well. On what I'm seeing people be much more on the investment side, be much more cautious. Hey, let's do inspections where maybe 2 years ago we wouldn't have. Let's do more cautious decision making. Still strong, just more cautious. So that's where you were going, but that's kind of what I was thinking about it.
Well, it's interesting. I'm seeing clients that try to sell a property, they miss the window or they miss the opportunity, and then they need to rent the property. And now it's my fault that they can't get the right leverage because the DSCR is really tight. Anything below 1.0, the odds of you going into foreclosure are much higher than if the debt service is above 1.0. So I can't give you something that's not there. And I think there's a financial acumen miss with a lot of people because I don't think they really understand. We're really trying to keep you at a place where if something goes wrong, you're not in trouble. Because you got to remember, we're not looking at anything but your cash reserves. Okay, we're not looking at your W-2 income, your 1099 income, none of that. So from an investor perspective, if it doesn't work with the bare bones of a low documented loan, why would I risk any more than 1.0 in DSCR on a subject property? So my question is that, as for developers, just like Mike, do you think about what the exit strategy is if it doesn't sell? And how much discount can you take before you're giving it away? Like the real estate investment landscape is constantly evolving. What's in demand for real estate investors can depend on what you said, Steve, market conditions, economic factors, and consumer preferences. Where are the trends changing in high demand areas for real estate investors, right? Whether it's build to rent, or build to flip, or rentals for that matter.
And and up here again, I'm from Boston, so this is still a weird market after 30 years. Is up here the reality is, Mike just told me the one that he sold for, I don't know, 800 something thousand. And the reality is he probably looks like he has half of that into it. Let's be generous and say he's actually making half. I don't think he is, but whatever. There's no way you could rent, even in the Poconos, a house that beautiful that, he's not going to get a rent that's going to pay a $400,000 mortgage, right? I don't see it. I've looked at Renometer, I've looked at whatever. So I think, which is why I'm also seeing in his play, I'm kind of watching his play, that he's doing a lot of land packages as well. Like, hey, you know what? We have this land here. We can put these 3 houses on it, and here's the finished price. Wait for someone to say, yes, I'm funded for that, then build. And I think he's still doing a lot of the other, but that was kind of an innovative play. And again, that was an affordable play. He's playing that down in Hazleton in the 200,000, right? 250, something like that. So I think I don't know if it's changing the game or he's just growing into it because he's only been at it for a couple of years. But we did talk about that. So some of these bigger ones, if they don't sell, you do have a carry cost. And I think it also depends on who you are as an investor. I don't want to spend the cash reserves to carry a mortgage on something sitting empty. Could I? Maybe, sure. But do I want to? So to me, I'm staying away from one where if it doesn't sell, I want to be able to rent it. I have 2 students right now that I'm transition into partners with. And I told him, I said, if it doesn't pass DSCR, if Joe can't fund it, and if it's not going to be able to rent and still survive the mortgage at least a 1 point something, we're not gonna flip it. Because I don't know what happens after November. I don't know what happens after January. I don't know what the world looks like. And the biggest thing I tell everybody is, don't look. You look at your comps. You're looking 6 months, a year back. Take a chunk off of those comps. We are no longer selling market. I'm selling Hazleton right now, insisting, well, Zillow says, and the last 3 houses says, I said, that's great. That doesn't tell me what I'm going to do with your house when I'm done with it in, February 2025. That doesn't tell me where the market's going to be then. Maybe something sold for 225, 250, 300 then. Maybe it's 25, 30,000 less. So I think he's adding some things to his mix to edge that. For me, if it doesn't rent, if a failure flip doesn't rent, I'm not sure I could sign my way to do it. If a failure self-storage doesn't rent, I'm probably a little bit longer term because I've got investors involved and they understand a little more time to ramp up.
Yeah. Yeah, I think people are starting to blend up their portfolio. I am starting to notice some changes with certain type of investors. Midterm rentals are becoming a discussion again. There's a rising demand, definitely in the medical space or traveling professionals, remote workers, and individuals in transition. They do have very attractive yields, but you got to be in a market that it offers a very higher return in lieu of a long-term lease, but you really need to understand how the maintenance works, the reducing the turnover and the management hassles that compared to short-term rentals. And short-term rentals, they're booting them out of all the urban cities. It's more of a tourism recovery play and the flexibility. I'm concerned about the ongoing maintenance. Like once you're in it, like you're chasing that carrot on short-term rentals forever. Like it's just ongoing. You know what I mean? I feel like the deferred maintenance is higher in a short-term rental, but I think there's the attraction of the better return and having opportunity for yourself to vacation in that experience as well. It's just a tough play for me to get my head wrapped because to me, the traditional single family home for long-term rental, I always saw rent growth and a suburban shift and the increased demand for single family homes in suburban areas due to remote work trends was more sense. But I always felt comfortable with multifamily. Like I like when you buy a 5 unit, it's a business. When you buy a 1 unit, it's personalized. So I like the multifamily because it's all about business. You're making an immediate, you know, difference in your income. Stable cash flow, the economies of scale, urban and workforce housing blends typically in a 5+ unit. I do like the build to rent communities. I love the growth trend in that space. Cost of building is expensive. I'd love to see the asset-based lending space get into more of the modular build because it's quicker. Same cost, but quicker. The expedition. I think that it'll come eventually because I think there's scalability in the modular builds compared to the standard build. And then there's always the commercial real estate plays, medical offices. With Steve, like you said, self-storage, and then industrial warehousing. And then nobody really brought up, and I like to always bring up, is the opportunity zones. Where are the tax benefits? Where are the abatements? The potential for growth. Steve, if you could mute a little bit, you got a lot of noise going on in the back for a second. Yeah. Sustainable green buildings, growing interest. That's market by market. Um, And another thing that people don't think about, the senior housing and assisted living environment. Some of these office buildings are ripe for assisted living and senior housing. They're already set up for handicaps accessibility, and they have the elevators, they have the escalators, they have the handicap parking. I think a lot of these office buildings are going to be attraction to the 55 plus or assisted living type of environment, especially near the malls. Because where do older people like to walk year round? In the mall. So you leverage the mall with apartment living in a 55 plus, you get a ton of tax benefits as a developer. I think that's going to be a huge play more than anything else. And that will satisfy affordable housing in some markets as well. And then you got to look at the mixed use developments, right? The urbanization trend, mixed use developments that combine residential and retail and office spaces are becoming very increasingly popular in urban areas. Some downtown corridors are finding love to that, but it's mostly in the urban settings that I'm seeing more of that blend. My concern is how long can the mixed use stay empty for that building to survive? Like I saw a massive development down on the waterfront in Philadelphia, beautiful apartment complexes, and they have all this mixed use space. Who's coming down there unless you live there? So like I've seen corridors just go ghost. Like there's no occupancy. It's all vacant. They come and they go, but they have apartments above. The apartments above are obviously not patronizing the mixed use below. So the live, work, and play concept could get a little choppy. And then flipping and burst strategy. Like anybody that's flipping right now has to look at it as well as a burst strategy. You can't bank on the house selling. Okay, because if you have to decrease values to sell the property, then you decide to refinance it, the appraiser is going to give you the last time whatever the price you had to drop down to. They can't give you the higher price. So the buy, rehab, rent, refinance, repeat strategy always applies to house flipping now. And then do you want to play the affordable housing play? Do you want to get into the Section 8 space? Do you have a property management company that understands government programs and the opportunities to partner with government programs within affordable housing initiatives? That could provide a very steady rental income and a less vacancy risk. And if there's an increased demand for housing affordability based on the current crisis, when you're giving free rooms away to the illegal immigrants, you don't have enough rooms for the people that really deserve it, to be honest with you. And where is prop tech and real estate technology driving your buy box? Like what type of software are you on? What type of software your property management is on? How is that transforming as you're growing your portfolio out? By staying on top of these demand trends, real estate investors can align their strategy with market opportunities and maximize their returns. Justin, I'm coming back to you real quick. Thoughts to our discussion this morning. What is the most important factor to your real estate buy box?
Yeah, definitely. You brought up a good point with the affordable housing aspect, and bringing some stability to whatever aspect you have, especially to the mid, like I said, to the smaller mid-sized multifamily, the 12 to 30 units, maybe even 12 to 40 units, and then especially anything above that. Let's say you had an asset that was a somewhat of a middle class asset, and people's financial situations have changed, and that's a real general example, but it's one that I think is relevant right now. Your consumer stability is something that you need to underwrite with some scarcity, and that's just my thoughts. And so, having that guaranteed income, even if it means you have more routes you have to follow. By the way, those aren't always a bad thing. Sometimes they help you stay in line and help you um, make the best decision for your property and for your whatever asset it is. So, having the government as a business partner, uh, for your property, I think is actually a really good idea and something. If you're building, well, most building standards are going to require you to meet their standards. But if you're buying, make sure that if you're doing renovations, you want to renovate to something that you can qualify for whatever their housing requirements are as well. So just be prepared to accept the most, what is referred to as the most stable uh, income out there for rental unit.
Thank you, Justin. And smaller real estate investors in 2025, no matter how this political movement is going on for our presidential election, will need to adopt agile strategies, leveraging niche opportunities and creative financing methods to compete in a market with rising costs, economic fluctuations, and increased competition. Let's go over some strategies I'm thinking, and again, this is just an opinion. And you know what opinions are like. We all have one. So we'll think about this real quick. I'm starting to favor midterm rentals a little bit. It's a niche opportunity, a lot less regulation, and there's some key markets you can go after, and some of the cities identify how midterm rentals work. So I'd probably do some like due diligence on that. Obviously, house hacking, buying a 2 through 4 family, renting one, living in one, and renting others might be a really good play of a low cost entry, leveraging primary residence loans and building equity. Then there's the build to rent in suburban areas, cost effective growth, suburban shift, long term appreciation. Maybe you want to consider partnerships and syndication. Sit down with a partnership and syndication attorney, pooling resources and a lower risk. Turnkey rental properties, hands-off investing, passive income, focusing on emerging markets. And then obviously there's the BRRRR strategy, maximizing leverage, focusing on value add, cost control. Then there's affordable housing investments, strong demand, government incentives, and Section 8 housing. You need to tie that in to a very strong property management. Then there's micro flipping, fast-paced strategy, technology advantage, and profit in hot markets. Thinking about or doing some homework and reading up on real estate crowdfunding, diversification, fractional ownership, passive income. You could look at REITs, publicly traded REITs or private REITs, or secondary or tertiary markets, lower entry costs, future growth, remote investing. And then there's always creative financing, seller financing, lease options, or even providing private money or hard money loans to others. Then you have vacation rentals in non-urban locations like target second home markets, profit from seasonal demand, regulatory research. So like I went to an event in White Plains, New York this past week, learned a lot about Vermont, from a gentleman who owns several Airbnb there. And I'm doing a rehab for hold up there as well. And I'm learning about how the seasons work and what kind of demographics are there. So by learning and talking with others and listening, and by focusing on these strategies, small real estate investors can definitely thrive going into 2025, despite economic and market challenges. Success will come from finding niche opportunities, using creative financing, and leveraging technology to scale efficiently. The question is, which strategy interests you most for your real estate goals and your real estate buy box? Want to go back to Stephen real quick? Stephen, some additional thoughts to what is the most important factor to your real estate buy box?
Yeah, and I think the most important thing I forgot to a couple more important areas is any kind of incentive. And to me, that is federal opportunity zones. That is different types of permanent, semi-permanent areas like that. Keystone opportunity zones, Pennsylvania, that you were kind of political and tapped out. I think medium term, what I call the earth rentals, the pre-built, pre-furnished, pre-set up move-ins where they can say 3 6 months. Airbnb arbitrage doesn't scare me still, where I rent and I sell one because I'm not into it for hundreds of thousands. And one thing that I'm starting to do out here, I didn't know there was a name for it until about a month ago, is transitional housing. This is setting up room rentals basically for people coming out of difficult parts of their life, prison, drug rehab, but it's not what the individuals pay. It's the state pays, the parole officer watches. You get all the safety and so forth of that. You get guaranteed money. And I think that with all of those, the one last area that I'm trying to find a way to build, and your motel idea, Joe, might be the right play here, is create housing that is more affordable, probably more studios, for the people who are single, maybe a small couple, working both low-end jobs. They can't afford anymore. Our one bedrooms are $850, $950. Our two bedrooms are a little over $1,000. That's a lot for up here. 5 years ago, they were half that. And trying to create things that those people who can still only afford to touch that can live in nicely. That's another growth area because sadly, the education system has failed a lot of people and they're not coming out with a lot of skills. So we're finding a lot more demand in our cheapers that are, they can't be big. They don't have to be big. So really it's going back to the transitional housing, the medium term, the furnished finders, I guess is one of the websites. I'm just learning that area. And creating things for the people who don't have the great incomes or working a job that's all you can do, and this is what they have for money, and making it something that they can live in. Because otherwise, they're going to be our next problem.
Yeah, there's a lot of moving parts, and I know a lot of people try to get creative with different ideas. The latest, I guess I would call scenario that they're trying to sell people on is called pad split. At the end of the day, a rooming house is a rooming house. You can give a name to it, but a lender is not going to lend to a rooming house because of the concerns of the transient environment. I mean, it's great cash flow if you can manage it. It's heavy management. I know people that do it. It's heavy management, heavy deferred maintenance, and you got to be on site most of the time. So if you're local to that type of rooming house type of environment, it could be great. If you're not, it could be an absolute disaster. So don't get sold on all these fancy new names they come up with every several years. I think that you need to find your niche and develop from there. I tell anybody, get licensed, not worrying about that it's going to get in your way. It's for the accessibility to be transactionally open, seeing more transactions. Like, people say, hey, I'd love you to train me on how to understand and underwrite a deal so I can be better at my buy box. Well, you need to send me transactions so we can review them and over and over and over again. If you don't send them to me, and you only call me once every couple of months to go over one scenario, you need to be active. You need to stay focused on understanding your market. Mr. Joseph Polidoro, good morning. Thanks for coming back. Brief overview, who you are, what you do, and thoughts to what is the most important factor to your real estate buy box?
Good morning, Joe. Thanks for having me. My name's Joe Polidoro. I have been in real estate local to South Jersey for the past 4.5 years. I have a background in mainly wholesaling, sourcing off-market deals for investors looking for extreme cash flow, and have also recently been licensed, so I'm able to play both sides. The most important thing for the buy box that I'm looking for, it's a little bit different than what was discussed by Justin and Steven. It's, are you willing to act now, right? Everybody has a criteria of what they're looking for, their returns, their cash on cash returns, IRR, cap rate, how the property is supposed to perform. But I really want to deal with people who are ready to make a decision. They look at the deal. I give my deal flow to where you have all the basic information, you have the pictures, you have LTV at 75% or 80% on a 7-year interest, which obviously, some people are going to get better rates with lenders out there, including Joe. So I give those options what that cash on cash return looks like. So it's really simple for investors to be able to make a decision. Does this work or does this not work? If you need resources for property management, I have those resources, including handyman as well. So, you know, what's stopping you from making the decision, within the week? And how are you acquiring your funds are really the two biggest things that I look for in a buy box.
Hey Joe, what do you think wholesaling is changing the way investors look at real estate deals and the industry itself? Like, where is wholesaling either being a negative or a positive, meaning the assignment of a contract, so people to make sure they understand what I mean by wholesaling. Where are you thinking the pros or cons are right now in your space?
I think it comes with experience. I think there's a lot of new people out there that, just learn about this watching a YouTube video or on Bigger Pockets, or maybe they're a year in and they've maybe done 10 deals doing this. I've been very grateful. I started out not knowing anything 4 years ago, and I've worked for the two biggest wholesalers here in South Jersey. So people who were doing 8 deals a month, and then I worked for a company and we were doing 12 to 15 deals a month, bringing in about 250 to 340,000 per month in assignment fees. So being able to get that type of experience, I feel a lot more confident, and I know my skills are better than a lot of these other wholesalers. So I would say the experience level is huge, and then kind of education behind the deals and resources are important aspects. Now, negative sides of it, some people, say, some wholesalers go into houses and they tell the homeowner that you're going to buy the house and you don't end up buying houses. What I've learned is I used to do it that way. Now it's more of a transparency side, and it's just, hey, I have a specific strategy for you. It's not like your typical realtor. I'm not going to be buying your house, but I'm connected, and I have resources and people who are able to close on a specific time frame. If you want to take a shot with me, I'll take a shot with you, and we'll go and see if we can get this property sold for you based on the terms, based on the specifics, based on the price. So transparency to your seller, I feel, is very important, and I know majority of wholesalers don't do that. Some people are surprised that I, pitch that. So that's important. Transparency, um, communication of areas and neighborhood knowledge. Right. I always get a little bit weary when I hear somebody saying I'm wholesaling in virtual markets. If people live in Texas and they're wholesaling deals in Florida and Phoenix and Maine, it gets a little eerie because I'm like, you don't really know the market. Maybe you flew there a couple times, but you don't know that certain towns are more predominant in a certain job setting or different resources, or XYZ towns typically have septic and well, and these towns have grant programs. Like there's a town, Salem City, that have some properties in heavy cash flow, anywhere from $600 to $1,000 a month per unit on cash flow. It's very high. Now you have a lower purchase price. It's predominantly Section 8 housing, which there's a need for, but the state and the specific town of Salem City has a grant with the state for improvements to the property. In addition to some of these homes are older, so there's a lot of lead-based paint. So they have grant programs to where they will come in, they'll remediate all the lead-based paint and get those homes up to speed to help everybody else out. So if you're dealing with somebody, that's not that specific boots on the ground, I would say that's a negative. But everybody has their own risk tolerance.
So, Joe, I've been talking with a couple of key investors that I work with, and they're ready to budget their own money to go out there and tackle the wholesaling play. Okay. What would it take for a real investor to partner with, say, a wholesale slash realtor to really do the same impact that any other wholesaler is doing? Because I think they're all feeding from the same trough. So, what technically, from what you've seen in the 4 years of your, young career here, what would it take to identify? Like, I had an investor last night say, "Listen, if I stop working with this guy, I'm going to lose 8 good wholesale deals a year." How does he make up that shortfall to identify for his buy box moving forward?
I would say it's either connecting with somebody who can fill that gap. It might be a couple people that can fill that gap. I know there's investor specific realtors who happen to find 1 or 2 deals a month off market. Now it could be at a little bit more of a premium rate than your wholesale, so you're not really still buying at that discount, but you are getting some opportunities. Or they could, you know, learn about wholesaling and start their own operation and really cut out those assignment fees that sometimes make or break deals, or sometimes are a part of the deal and pocket that money for themselves. Something I will say is I worked in companies to where we've spent between $15,000 a month in marketing to yield 4 to 5 properties. Say on a $15,000 spread, so you're spending 15 to make 45. And in the bigger company I worked for, they were spending $110,000 a month. So, I knew that there was a month where we made 89,000 in assignments, not a good month. There was another month we made 153, not a good month, right? The months to where you're making something in the twos and the threes, those are good months. But I would say, does that investor want a whole nother business added on to their existing business? Do they have the resources? Do they have the skills? Do they have the leadership skills to build that out? If they do, great. Not everybody, wants to be going to properties and, walking into houses to where you may fall through the floor or has weird smells, and now you're congested for the next week. So it's a decision that they would have to make, but those are options that I would suggest.
Yeah, listen, this has been some really great discussions, and at the end of the day, you really need to be focused on several things with your buy box. From what I've gotten from Steve, Justin, and Joe, location, location, location still works. Defining your investment goals is important. Having financial acumen and knowing how to analyze a deal, considering market conditions, the property condition and repairs, and evaluating potential risk, and understanding your financing options, and always, always understanding entrance and exit strategy. Real estate investing can be a rewarding journey, but it requires adherence to the essential buyback box rules to minimize risk and maximizing returns. So, Joe, final thoughts, and then we'll get some final quick thoughts from Justin and Stephen.
Yeah. I want to say thank you for letting me speak today. And I think there's a lot of pros that can occur kind of in that off market space. I think it's aligning with somebody who, I saw Steven comment. He's like, if a wholesaler's not being transparent, I don't want to work with them. And I understand that. You want to have transparency. You want to feel good about the property that you're purchasing, and make sure it's a seamless, smooth process. So I would say whatever you choose to do in this real estate business, if the people you're working with don't align with your core values, eliminate them quick.
Cut the cord. Thank you, Joseph.
Thank you.
Justin, your final thought to what is the most important factor to your real estate buy box? Justin, going once. Justin going twice. We'll come back to there. He is. That's all.
Final thoughts. It sounds like they're really doing your homework and being prepared. Generally speaking, but just put as many safety precautions in as you can, and make sure you understand the market and your strategy.
Thank you, Justin. Steven, your final thought to what is the most important factor to your real estate buy box?
And I think that my two final thoughts are one, what your location is, what you're comfortable with. For me, if it's 5 and under, it's got to be within a 30-minute drive of my house. If it's small commercial, it's got to be within a 30-minute drive of my house. If it's going to be far away, there's got to be a lot more into it, or there's got to be a team. What the gentleman from Jersey said about knowing your town. I've been wholesaling since almost since I started buying property. And I don't work outside of an area that I know. If I have someone that lives there and knows what side of the tracks, fine, I'll JV in that market. But you can't fly blind. And the last thing is your power team. It all comes back to, okay, we can all price shop for different things, but your power team should include the lender or maybe two lenders that you go to for advice, you can rely on, and they're going to give you the best deal they can, and in exchange, you're going to be loyal to them. You're going to have an accountant, all your different staff. And if the deal calls for a realtor and you're not one, find one. If it calls for this, find that person, get references, because we can't know it all. And at the end of the day, we don't want to do it all. We want to put out money and have money come back. And hopefully our time is off to the side. So having your power team, having relationships with them, and if you don't have anything come up for a while, still check in with them. Let them know you're still alive, you're still out there. So that's really it. Knowing your locations and your criteria, having your power team, and knowing the area or having boots on the ground. I had one student who just lost their shirt because they had a realtor who didn't know what they were doing, and they didn't know the market, and the deal went badly. And she came to me too late. I couldn't stop it. So that's all I have, guys. Thank you so much, Joe.
Thank you, Steve. And my final thoughts here is having a strong power team and understanding your real estate buy box is essential for your success in real estate investing, especially for the small investors that are relying on a network of professionals to help manage deals, navigating legalities, and maintaining properties. Your power team will consist of various experts that can provide you the necessary services and advice to help you grow and protect your investment portfolio. Reach out to our moderators. They've been great together. That's my call to action to you. Try to get a call with them or a Zoom link call with them, whatever it takes to get in front and maybe, pick each other's brains and see how you can work together. They all bring different elements to the front line as a real estate investor and a professional. So I want to thank them for their insight and their advisory or their opinions, because none of this is scripted. This is all raw information. So I want to thank them. I want to thank our sponsors, Mr. Yarlo Perkins of Perkatech, Ms. Linda Pelagas from Realty 411. I'd like to thank MB Capital. And of course, I want to thank Lenmark Capital, where I'm a senior loan analyst providing asset-based lending nationwide. We're here every Saturday morning, 8 a.m. and every Sunday morning, 9:30 a.m., providing education, networking, and strategy. And my quote this morning, don't be afraid of being outnumbered. Eagles fly alone. Pigeons flock together. See you tomorrow morning at 9:30 a.m. Eastern Standard Time, and have a fantastic Saturday morning. And I'll be ending the room in the next 30 seconds. Thank you.